Hi, I'm Tim Jubak, and welcome to my YouTube video for Thursday, June 9th. If you like this video, please like it, give us a thumbs up. Subscribe to my YouTube channel. That way you get notification of when we're doing the videos. We're doing Wednesdays, Thursdays, we're doing 3 a week. So if you subscribe, you get notification of when they're going up. If you like this stuff and you want to see more of it, you can go to my free site. That's jubakpicks.com. It's got 3 portfolios, including the dividend portfolio that I'm going to talk about in my next video. Want even more, you can go to my paid site. That's jubakam.com. And it's got 6 portfolios, including some options and ETFs. And that sort of fits more in with my main theme today. One of my favorite moments in the Disney version of Peter Pan is when Captain Hook, who's kidnapped Tiger Lily, turns to her and says, "The tide is rising, Tiger Lily." She's been tied to a pole in a cave. That's how I feel about treasuries. So today's title is actually "The Treasury Yield Tide is Rising." Today, on the 9th, the yield on the 10-year treasury is flat, but it's above 3%, which has kind of been the ceiling. A couple of days ago, back on Monday, it broke back below 3% to 2.98, and it looked like there was a good chance that we were going to move incrementally downward and we weren't going to have that kind of break above 3%. But today we're back above 3, we're at 3.02, and everything else has moved up as well. So we've got the 30-year yield at 3.16, 5-year yield is at 3.05, slightly higher than the 10%, which tends to mean that people think recession is coming, inflation is coming, bad stuff is coming. The 2-year, which is the most sensitive to Fed intentions, is up to 2.81. This is the iShares 20-year Treasury bond ETF, so it tracks the 20-year Treasury. So it's a kind of long bond, but you can see that over the last 6 months, this is the price of the bond, and as the price goes down, the yield goes up. So we're talking about pretty much a very steady decline, but with an increased acceleration of the decline really from the end of March. One of the things I noticed, I checked the CME Fed Watch tool that tracks expectations for Fed interest rate moves using prices in the Fed futures market. So one of the things that's interesting is that, okay, so we're looking at a Fed meeting on the 15th of June, settle rates. And it looks like everybody has assumed that the Fed is telling the truth, and the Fed has been saying 50 basis points, 50 basis points, 50 basis points. So we're looking at a 92% chance that the Fed is actually going to raise interest rates by 50 basis points. I don't know what that other 8% is thinking, but what's interesting is I don't think they're at the 25% range. I think they're looking for a bigger increase. Go out a month to the July 27th meeting. Right now, the odds are, and according to the CME FedWatch tool, are about 80% for another 50 basis point cut. Now the market has been sort of vacillating and saying, well, maybe we'll get 1 cut, maybe we'll get 2. But what's interesting to me is that we've also started to build a big position in people who think not 50, but 75. The odds of a 75 basis point cut, which would be really extreme, have moved up to include about 20%. Higher than it's been. This is a position that's sort of emerged out of nowhere, but it's unlikely, I think, that we'll get 75. Go to September, which is kind of the crux meeting of the Fed. This is September 21st. The market rally, the bear market rally that we got a couple of weeks ago, start around the 13th of May, was on a basis that maybe the Fed would only raise 50 basis points in June and July, and would sort of either pause completely in September or only raise by 25. So right now, however, it looks like we're unwinding that belief. The odds of a rate increase from the Fed in September being only 25 basis points are down to 22%. We've got about 60% looking for 50 basis points, 14.7% looking for a 75 basis point cut. Again, we're starting to see some extreme positions out here. Basically what these figures are saying is that, hey, inflation is going to be harder to conquer than the Fed current policy is doing. We're going to look for more rate increases for longer, And that's why I think we're starting to see the tide rising in Treasury yields. Thanks for watching the Jim Jubak on my YouTube video for June 9th. If you like this video, please give it a thumbs up. Subscribe to my YouTube channel because that way you get notification of when we do videos, and we're doing about 3 a week. If you like this piece and want to see more stuff, go to my free site, that's jubakpicks.com, 3 portfolios, or you can, if you want even more, go to my paid site, that's jubakam.com, and that's got ETF portfolios, including some that track what's going on in the Treasury market. Thanks very much for watching.